Hey everybody, this is Jason Alba, and it has been a heck of a long time. I took a few months off, and then I took another few months off, and a few months off, and then it was hard to get back on the horse. And I kept thinking, how am I going to start doing these videos again? And my team asks me to keep doing them because they use them in their email marketing and stuff. And I was like, I don't know, I'm not ready to say anything. And I got this like prison wall background behind me. I'm actually not in prison. But I just wanted to give a quick little lesson real quick before we jump into what we're going to talk about today, which I'm really excited about. Sometimes we're good at stuff, right? We do stuff. We're used to doing stuff, and we're comfortable doing it. And then we kind of get like we fall off the horse or whatever analogy you want to use. And it's hard to get back on, right? Like it's embarrassing, or maybe you don't remember something or whatever. And so the lesson for me is, as ill prepared as you may think you are, get back on the horse, even if it's uncomfortable and even if it's weird and stuff like that. And that's a little bit what I'm doing today. It's been a long time, and I feel bad for the inconsistency, but here we are. And so here we are. And so today we're going to talk to my friend in Texas. I think we'll clarify that in a minute. But Rob Saunders is a buddy of mine that I met through my in-laws, and Rob's in the financial space. And I see a lot of posts on Facebook from Rob about investing, and really a lot of like it seems like it's like the basics of investing for beginners, but it goes beyond some of the cliche stuff that I've read, like the really, really common stuff. And it seems like he has a little different twist. So let me bring Rob on and hopefully have a really good conversation about how to invest.
I hope so too. Thanks, Jason. I appreciate your time.
You're welcome. So when I was thinking about putting together this conversation between you and I'm thinking about some of my older kids who are saying, Dad, I want to invest. Where do I start? What do I do? And then I'm also thinking about my jibber jobber audience, which is typically people that are in transition, people that are in a job search. And so I think there's so many people out there that are confused, right? They don't know where to start. They don't know, okay, I've heard of this mutual fund thing, which I don't think you're a super big fan of from what I've been reading.
Not at all.
Not at all. Okay. So I want to dig into that a little bit, because like the general idea of the easiest and smartest investment strategy is like, hey, take a little bit of money every month, automate it, dump it into mutual funds, and then just kind of walk away. And by the time you're 65 or 75, you'll have millions of dollars or whatever. I think the whole thing has been muddied up with like the Bitcoins and all that stuff over the last few years. You see these kids on YouTube that are like, hey, look at the mansion I'm in and look at the Lamborghini I'm driving. And if you would have just invested in Bitcoin or Tesla or whatever, like when I did, then you could have been rich too. But if you buy my book, I'm going to tell you how to do it, right? And so I feel like there's a lot of options, but there's so much confusion. So talk to me as if I had my 18-year-old kid sitting here next to me. What the heck, Rob? Like, where do we start and what do we do?
Well, again, thanks, Jason. You're right. It is confusing out there. And one of the things that when I went through my training was that my trainer actually told me, he goes, don't teach them how to do it, because they will. And that struck me a little bit, because he's saying two things there. One is anybody can do this. He admitted that in that statement. But the first part of it was don't tell them. That tells me that, well, wait, we need them not to know. And so, ergo, you're talking about this confusion that you feel. Everybody does. And believe me, that's part of the reason why I became a broker, because I got tired of having these people talk over my head and having the glaze in my eyes. So to follow up on your format here today, talking to an 18-year-old, it would be to start with one thing at a time, because I know one of the worst advice any young person can get is be aggressive. First of all, a young person doesn't really know what that means. Okay. What does aggressive mean? Well, what that means is, well, you have to come to me, okay, a financial advisor, okay, which are salesmen. Um, it means you have to go to them. And so if you go to them, you're going to pay them. And so that's the industry. As a matter of fact, they live off of fees and commissions. And so nowadays,
When you say they, are you saying we, like you live off of, or do you have a different model?
I'm totally different model.
Okay.
Okay. Yeah, I have a program, and yes, you'll pay me at first, but after first 3 or 4 sessions, you don't need me anymore because you will know it because it's a simple process. Now, what I say is I help beginning investors begin because that seems to be the hardest thing.
Mm.
And so to start, maybe what we can start about is like the accounts that you might come across when you start. Well, what I would want people to do is start an IRA. Now there are two kinds, and one has been way oversold, and that's called the Roth. Okay, a Roth IRA means, excuse me, a Roth IRA means you pay the taxes first, and then when you retire, the money comes out tax free. Okay, well, that makes sense. You already paid the taxes. Okay, but what people aren't understanding with that is you make more money during your working life. Ergo, your income tax is going to go up during your working life.
So you're paying a higher tax bracket
Exactly
when you're
right.
putting it in, but when you're pulling it out, when you're in a much lower tax bracket,
Mhm.
and you would have paid a lot less in taxes on that money. Is that what you're saying?
That's exactly what I'm saying. And the thing is yeah, of course, when you retire, you are going to be in a lower income bracket. But here's the other thing: when you pay that Roth money, that money goes to DC and it never comes back. Okay, what the traditional IRA allows you to do is keep that money. Okay, and for the 30, 40, 50 years you'll be working, you can keep that money and have that money working for you during your working life.
When you
Okay.
say keep that money, are you saying the money that would have otherwise gone to taxes?
Hmm.
So
Well,
let's say,
some of it. I want to be accurate. It's not going to be a 1-to-1 ratio. You get to keep all the money you would have sent. But when you do contribute to a traditional IRA, you get a tax break. You actually get to keep more of your money.
hmm,
And what I assume and hope people will do is put that into your IRA, and that will have the compound growth over 30, 40, 50 years. Okay, and then again, when you retire, you're going to pay at a lower rate. But I don't want people to get hung up on this. I'm not. It doesn't matter really if you do a Roth or a traditional. I just try to teach people about it so they have both eyes wide open.
yeah.
Okay, and so but I don't want them to waste too much time doing that. I don't want this to be a stumbling block just to start. The thing is just start.
Well, okay. So quick question. So if I do an IRA, if I'm 18 and I do an IRA, that's still like that. I can't pull it out until 60 whatever.
Yeah, yeah,
Okay.
59 and a half,
So
correct.
what's the benefit of doing that over just like making my own investments outside of an IRA?
Well, outside of an IRA, if you were to have what they call a realized gain, okay, and I don't want to get too complicated, but what it is basically is if you buy and sell a stock, if you made a gain in that time period, you pay the taxes during that year.
Only if you sell it.
Yeah, only if you sell it, correct. It's called a realized gain. An
Yeah.
unrealized. Go ahead.
So we got Roth IRA, which is tax me now, don't tax me later.
Hmm.
Traditional IRA, which is put my money in and tax me when I take it out.
Hmm.
How is a traditional IRA different than me just investing freely in like using Robinhood or something like that? I can put it in And maybe if I never sell it, then I never realize and I never pay taxes on it until I'm 60, whatever. Is it just a discipline thing, or is it
That's
kind of
true.
the
Yeah,
same,
well, that
like
would be
self-managed?
correct. That would be correct. You would actually, if you were to hold it for your entire life, yes. Okay, but that's not how they want this to go.
Yeah.
The industry. The industry wants you to buy and sell.
Yeah.
In fact,
Because money changes hands every transaction, right?
that's
And when I
correct.
say money changes hands, like commissions and fees and whatever.
Right. Yeah. Now here's where today, like your 18-year-old, they have better benefits than we did when we were, because if you wanted to buy a stock when we were 18 or 19, it was going to cost you 80 to $100.
Wow.
Now it's free.
You mean in
Okay.
fees?
Fees. Yeah. You can go on Charles Schwab, TD Ameritrade, open an IRA. And if you can buy and sell stock and not pay a penny.
Well, then that's why I didn't invest in Apple when I was a kid, because I didn't have $80 to pay the fees.
Is that right? Yeah,
well, I don't know, but I mean, I feel bad about not investing in Apple. I should have,
yeah. Well,
but I
so
didn't.
do I. Welcome to the club. There's a $15
So now, and I want to talk about these opportunities in a little bit of like where to go, because I think that's another big question and stuff like that. But I think it's awesome. Like my kids, one of my older kids was like, "Dad, you got to get on Robinhood," and then I think I got on Robinhood through a link from him, and then he got some like free credits or stocks or something like that, and it was pretty cool for him. But I've seen him buy and sell stuff. And I mean, he just goes into his app and pulls a trigger and he's like, yeah, I bought it for 1,000 and it's up to 3,000. And I'm good now. I'm going to take it out. And I was like, man, what the heck?
Yeah,
I was not thinking anything about this stuff at his age, you know?
Nor was I. And there was very few of us that were, because usually it was reserved for those that had money. And so ergo, what they decided to do was invent what they call the mutual fund and the 401k. And the 401k now, it's a great benefit, but really only if they match. If they don't match your contributions, then there's no benefit.
It's not worth it.
In my opinion. And here's
because you're
why.
saying there's alternatives that are as good or better.
Yeah, and here's why. Now you said where to go. Now let me explain, or let me understand what you were saying on where to go.
Well, I mean, so let's say my daughter has a job and she has like $200 a month that she's like, all right, here's $200. I can invest it, whatever that means. What do I do with that? Like, do I go to TD? Do I go to Robinhood? Do I?
Okay, well, here's the one thing about
Robinhood. Do I get a mutual fund?
Yeah, here's the thing about Robinhood is you can't open an IRA in Robinhood. It's strictly geared towards traders.
Right.
And it encourages that trading. Now, when you start to get into trading, okay, and just hear the definition of a trader versus an investor, is a trader is one that buys and sells more than 4 times a week. That's the definition of a trader. An investor means you're just buying it and you're holding it.
Buy and hold.
Yeah. So and believe me, they are trying to encourage trading. And trading is tough because basically what you're looking at is a gain, right?
Hopefully.
And again, we all want to do that. However, it's very short-term thinking. You're listening to people now. If they go into and research the company itself and they make an educated decision about that, okay, fine. You're not going to get any argument from me. But for young people, they usually don't have the background to study balance sheets and inventories and what the CEO says every quarter, because let me tell you, they speak and you think you know what they're saying, and it's nothing what they meant.
Yeah.
So it's a very complicated world, and so if they have success that way, who's to say if that's wrong? But what I'm saying for people that just want to start and try to learn this game, okay, I don't want to really call it a game, but if they want to learn it, you start with one. And usually what I try to steer people towards is dividends, a company that pays dividends. Okay, now there's a and dividends is basically money a company gives you because you own their stock. And so every quarter they deposit money into your account. And that's a hard concept for a lot of people to believe. What do you mean? What do you mean they give me money? That doesn't make sense. But they do. Okay, and here's the benefit of those companies that pay dividends. First of all, well, let me bring in another concept here. It's called a dividend yield. Okay, a dividend yield is very similar to what that you might think of as an interest rate. Okay, a CD, a certificate of deposit, you basically loan the bank your money and they guarantee you a certain interest rate. Well, a dividend yield is the same thing, except a dividend yield is basically, there's a formula to it, but all you really need to know, and people can go on to Yahoo Finance, and that's where I come in, is I show you Yahoo Finance, where you can go to look up any company in the world, and you can see if they pay a dividend. And that dividend yield is important, and here's why. There's a concept called inflation, which runs about 2 to 3% every year. Okay, and so
average, right?
Average, that's correct.
Recently, it hasn't been 2%.
No, this year is going to be tough, and last year's was tough too. I think they claimed 7%, but most of the financial and the
it didn't feel like 7% to the person buying food.
It was closer to 12%. Yeah. Is the financial gurus that I listen to or read. So, but we're not going to chase inflation. We're going to go by the averages, and averages out about 2 to 3% a year. Now, before last year and the couple of years before, inflation rate was almost zero. Okay, barely, because the Feds keep the rates really, really low. Okay, so the money could be cheap and keep investing. So inflation. So we had our party. Okay, now we're starting to
wake up the next morning and have to clean up from it.
That's right. Yeah, and try to get over the headache.
Yeah.
So, but that dividend yield is important because the inflation rate, like I said, was 2 to 3%. Okay, over time. So if you can get that dividend yield to about 3% or above, that guarantees you're going to beat inflation over time, just with that one investment. Now let's see. Now AT&T used to have a dividend yield of about 8%. Okay, that's just the dividend. That does not count the growth of the stock.
All right, pause here, just so I understand. Let's say I have $1,000. Okay, and so I put $1,000 into this is all examples. Okay. So we put $1,000 into AT&T, and it's 8%. So you're saying I could expect to get over the quarters about $80.
Okay, right? Over the year.
It's paid not quarterly. Each quarter, but each quarter I would make, say, $20, not accounting for inflation and all that stuff. But over the year, I'd make 8%, which is they would give me $80 each quarter, or however often they paid it. Right. But also, the value of the stock still the value of what I own still goes up.
Well, that's we hope, right? And you got to understand, these dividend companies, the dividend paying companies, that's how they're paid usually, in stock. So it's worth they make them have skin in the game. Okay, so if my stock grows, if I can get the stock to grow, well, my pay increases too. So there's incentive for most CEOs when they have a dividend paying company.
So hold on. I just want to make sure I understand this. So if I invest in a company that's not dividend yield, basically I'm hoping that the value of that stock grows, just like my AT&T does, right? Or would, or could,
That's
or
right.
should, or
Yeah.
whatever. But the benefit of the dividend yield is I'm getting some money back right now that I can hopefully reinvest. I mean, that or live on, depending on your stage of life or whatever. But as an 18-year-old, I'd say, dude, do not take that $80 and spend it. Like, put it right back in.
Right. Well, that's why I want people to go into an IRA, because it keeps them from pulling it out.
So
It
the
just,
IRA is a what do you call it? A tool, a vehicle,
correct, a box.
a
Yeah,
box. Okay,
a
so the
box you
IRA,
can put.
it's set up so that when AT&T kicks back the $20 every quarter, that just automatically reinvests it. I don't even
Well,
touch it.
yeah, you can reinvest it, or you can just keep it in cash. And for beginning investors, I want them just to keep it in cash. And here's why. You had said earlier that you want people to do it automatically, and that is probably the best advice. But I don't want them to invest it all the time, because what I want them to do is I want them to start buying. Well, you said $1,000, and that's a lot of studies that I see and read about. What do I do with $1,000? But what I want people to do is buy 100 shares of a certain stock. Okay, and the reason I want that is because, first of all, it's going to be easier to know what you're going to receive. Okay, and you're going to get used to it. And in the investment industry, it's called a round lot. Okay, and there's a theory in investing that when people start buying what they call odd lots, like, okay, I want to buy 22 shares or I want to buy 13 shares. The first indication, the first thing that people think about, or really the big investors think about, oh, okay, we're getting a lot of unsophisticated investors going in. It's time for me to pull out.
Mm.
Okay, that's an odd lot theory. That's I don't know. I guess I learned it in my training, but it does signal to the broker or whoever that this person is probably not serious. But Robinhood kind of equalizes all of that, even though I don't like the fact that they don't allow you to do an IRA.
Yeah.
Because it what it does is it fosters the trading in all of us. Because
it pushes you to become a trader instead of an investor.
right, and see, the thing is once you're a trader, you go by, did it go down today? Oh, I better get out. Well, you don't go back and go, well, what happened? Why did it go down? Because probably what you've heard to replace that, and the industry is very good at this. They go, oh, okay, we'll buy this. Okay, and then so somebody who's not very sophisticated, they will, okay, well, gosh, everybody's buying this, I better buy it. And see, I don't want them following the herd. I want them, because once you buy, and here's why I don't like mutual funds. Here's the main reason, is because most mutual funds have AT&T in it. Okay, but it has a very, very small amount. And plus, if you have a mutual fund and they start talking about AT&T on the radio or TV, you're not going to listen to it, because you don't even know if you have it, first of all. And so it just goes right over your head. But if you own AT&T shares and something comes up, AT&T, what was that? You know, your ears are going to perk up, and you go about learning about the industry. Okay, and then, like, let's say one day AT&T goes down, but you see Verizon go up. Okay, and so what I hope happens is that you find out, well, what happened? Why did? Because usually you'll see that they go in lockstep. Okay, but sometimes they'll be different, and like AT&T may have lost a court case, or Verizon may have created a new technology. And so you go about learning about the industry and the segment. And after a year of that, I'll say almost guarantee, but I can be pretty sure that you're going to know more than most brokers out there, because they want to sell you a mutual fund. Why does a broker want to sell you a mutual fund? It's because that broker gets paid every year whether that fund goes up or down. It does not matter. Now, when you buy a stock, okay, nowadays you don't even have to pay for that now, and you get all the dividends. Nobody gets to put their hand in your pocket ever again. Okay, so it's everything that you earn, you get to keep. Okay, nobody gets to. So that's why, but that's why mutual funds are so oversold. Okay, the other thing too is it fosters ignorance. Sometimes there are 200, 300 companies in a mutual fund. Okay, that's not diversified. That's scattered. Okay, diversified means, okay, you got some of this and some of that. But that's why I want people to start with one company at a time. Okay, buy 100 shares of one company, have the dividends go into cash. Okay, and like you had suggested before, hopefully you've got contributions, your deposits coming in automatically. Now you're looking for your second company. Okay, your second company. Let's say, I think AT&T now the dividend is right around 4%, so it's still above the inflation rate. There's a company called Altria, or I think BP is even a better example. BP, I think, pays about a 6 to 7% dividend. Okay, again, that's well above inflation. I say so. Now you have two companies that are paying you dividends. Okay, and so now what I and this is what I want people to do is I want them to build up to where they get about 10 dividend paying companies. I mean, so you've got that foundation set, you've got dividends coming in, and now you start swinging for the fences. Okay, because now you've spent some time in the industry, you've probably seen the fads come and go, and you probably have an ear for somebody that's been pretty truthful and not outrageous, that have been reasonable, and now you can go take a swing at like a Tesla or an Amazon or an Alphabet.
All right, hold on. Before we get into that, I want to go back to the buy 100.
Okay.
So, all right, I got my kid here, $200 a month, saving up, trying to get disciplined to like not spend her $200 a month. How do you buy 100 shares when you only have $200 or $400 or $600?
Well, I would just save it until you have enough.
Just save it until you have enough.
Right. Just save it. I mean, nowadays, it doesn't matter really because there's no commission coming off now. So, I mean, who am I to say don't buy now? But you go ahead and buy because it doesn't cost you anything, and you can start to see early the dividends come in.
So when you say save it, that's not save it in a bank account. That's actually just go buy the stock.
Just in the IRA. I want your deposit to go inside the IRA, because remember that's where you can defer taxes until you're 70. So that's why I want people, because it kind of instills a little discipline, like you want. Okay, you can't take this out, or you're going to get a penalty, and you're going to get taxed.
Yeah.
So there's a double thing that keeps them on. Maybe I better not. And then maybe the young people will just start and say, okay, I don't want to touch this ever, and just maybe ignore it for a while until they have enough cash to go buy the next company, and until they have the foundation. The 10 is what 10 to 12, because by then they kind of have an idea of what they're doing. But if they're just buying and selling because somebody said something, see, that to me is gambling. That's the epitome of gambling.
All right, so let's go into the swing for the fences. So basically, the idea is that I've done this with 10 companies. I get it. I'm starting to get dividends. I'm starting to see some money come back. I'm probably seeing the value of my stocks increase. So I'm feeling good, right? Like everything's pretty cool. My ears perk up when I hear about AT&T or whatever companies I've invested in. I see them in the news. I'm like, ooh, I own some of that, and oh, they just did something cool, or oh, they just did something I think is kind of dumb.
Right. Yeah.
So you're paying attention, and then you say the next step is to swing for the fences, like, and you say Tesla, Amazon, whatever. What does that mean?
Well, that means if you want to, okay, because you can do this the rest of your life. You can buy dividend paying companies. But what I'm saying is because I know there is the tendency to maybe swing for the fences early on because you are encouraged to when you're a young investor. Be aggressive, man. This is
Yeah.
the time to do
I
it.
want to be aggressive, and I'm not necessarily young, but I figure I have 10 or 20 years of good income earning
Mhm.
ahead of me, and it feels like being aggressive is like the right thing to do at my stage. But you're saying that's not wise.
Well, at your stage, that's because what I would assume at your age is you've got some wisdom behind you.
Well,
Okay.
that's a big assumption right there.
Well, um, but the thing is you've got some years behind you, and you can probably kind of discern whether people are blowing smoke or if they're really honest, advocates for instead of just the industry. Because that's the thing, the industry is very smart. I mean, they are very smart, and I'll be honest with you, the best psychologists are not in are in psychiatry. They're not in clinics and hospitals. They're in business.
Hmm.
Okay, I mean, and here's a good rule or good thing to look at. Next time you have your yard sale, how many things did you buy that you had to have at that point, and now you can't? Why in the world would I ever buy this? Well, it's because somebody convinced you to do that, and they're getting better all the time. They've been doing this since tulips. The
Yeah.
tulips, the industry when they blew up. So there's a lot. They know the words to say.
Yeah.
They have artificial intelligence that can pretty much guess pretty much what you're thinking almost at the time you're thinking it.
Yeah.
They're not
So,
that good.
so okay, so let's jump over to the swing for the fences, and now it's time to do. Let's just say Tesla or Amazon or Google. What does that mean? Am I going to save up for 100 of those? Because those are expensive.
Yeah, that's the thing. Those are very expensive. See, that would be that would be personal assessment because I don't. This is what I call the Icarus syndrome. Daedalus and Icarus, where Daedalus told Icarus, "Hey, they made wings. They made wings to get off this island," and he told the sun to don't fly too high, or the sun will melt the wax and you'll lose your feathers. Well, that ended up what happened. Here's an interesting tidbit. I just realized, or somebody just told me this. They took out the part in that story where it says, "Also, don't fly too low." Now, have you heard that?
Nope.
Okay, he says, "Don't fly too low because you'll get some water and some moisture on your wings, so that will also bring you down." And I was told that the reason they took that out in the 1800s or maybe 1700s is because the industrialist didn't want them, they wanted what they call compliance. So let's just take that out of the story. Now, I honestly don't know if that's true. I'm going to have to research it, but it just sounded interesting to me.
Yeah.
But here's what happens, especially with the guys that I try to help, is they get 3 or 4 companies and they go, "Oh, I got this. I figured it out." Okay. And so I'm going to go buy this. Well, what I'm going to do is because I know this is going to work, I'm going to sell what I've got, go buy that, and it doesn't work out. And so now they're back to square one. And then they blame me because they say, "Well, it's just gambling." And I go, "Well, yeah, that's exactly what you did is you gambled." But so what I'm saying is and here's the value of what I try to do is they it's what you learn that has the most value because markets are going to crash. Okay, they do all the time, not all the time, but they do. And so let's say, well, you bought AT&T. I think right now it's around $25, $26 a share. So let's say you're getting, let's say 5%. Okay, and let's say all of a sudden the market crashes and it goes down to about $18, $16. Okay, well, the market crash, what does everybody do? They rush to go out, get out of the market. You're going to lose everything. But if you've been paying attention to what prices are, and that's the thing about mutual funds, you never know what the price of a stock is. You'll never know. So once you know what AT&T cost and you see it go down, or like a market crashes and you see it goes down to like 16 or 18, what are you going to think? You're going to think, well, maybe I should buy more. Okay.
Because
Because
it's on sale.
that's right. It's exactly on sale. And see, that's where the value is. And that's where wealth is really created. Because you know something, not because somebody's telling you, it's because you know it. And that's the best value of this kind of a program. Um, I had another thought, and like always, they're
Yeah.
fleeting.
Let's go. I want to understand what swing for the fences means, like with Tesla. Does it mean like I'm going to go big in Tesla now, or I'm just going for a big sexy thing?
That you're just going for a big sexy thing. You're just
okay.
because
So you're saying the first 10 should be stuff that I'm really comfortable with. I've done it fits a certain criteria, like a certain amount of dividend, I can afford it, whatever.
Right.
But then after I get it, then it's like, okay, here's some of the big ones that everybody's talking about. Now I get to make some more educated choices on those ones. And what am I going to get? Amazon or Google or Tesla? Is that kind of what you're saying?
Yeah.
Or this time I'm more educated?
Yeah. Well, I mean, because there may be another company that you've been looking at, because you'll come across companies that people will hype. Okay. And then you'll see that sometimes they pan out and sometimes they do not. Okay, but the thing is now that you're engaged, you're looking at individual companies. You're going to start to see individual companies. If you have a mutual fund, you're not looking at anything.
Not really paying attention.
Well, you can't with 300 companies in there.
All right,
even your broker doesn't even know what's in it.
Yeah, or the percentage of, or the value of. So let me defend, or the broker wouldn't know what the percentage or the breakdown of the companies is either. They're like, oh, we have AT&T, and not realize that it's a tiny sliver just to be able to say they have AT&T, probably.
Sure, that's exactly right. Yeah.
Let me defend the common dude out there, like me, common. I'm sitting here saying, okay, let's say I got $200 a month. I don't want to think about it, honestly. I don't want to study the companies. I just want to pick a mutual fund that has a historic return of whatever percent that I like. And then I just like put money in it, and I go on living my life. I'm busy, man. I got family. I got companies that I'm dealing with. Like I'm busy. I don't have much time to like study these companies, and it's not necessarily my passion. I just want to know, I want to make a good return.
Right. And that's perfectly okay. But what are you going to say, or what are you going to think when the mutual fund goes down? Are you going to ask your broker, well, which companies brought it down? He doesn't have time to do that, and neither do you. But it's not bad. In fact, so many people have done well that way. I'm not going to argue with anybody that way. However, this is something that was brought out I guess a few years ago by this an NPR series called Frontline.
Okay.
And it was called the Retirement Gamble or Crisis. I'm sorry. This is something I had seen about a year ago.
Sure.
And it had one of the old, it was called John Bogle, and he actually ran a mutual fund at the time. And he said he'd get away with it because he had very, very low fees. But they were doing most of the mutual fund fees, let's say by Fidelity and them. And of your gain, even though you gained a lot, the mutual fund took over 60% of that through fees.
Of your gain.
Of your gain.
Wow.
60%.
So you're saying if I gain 10%, they would take 6% or 60%
Yeah.
of my
Well,
gain
and here,
as fees.
yeah, and there's so much to go with that too. First of all, you whenever a mutual fund company charges you for the mutual fund, you should get a tax break. Have you ever gotten a tax break from your mutual fund? Well, no, because usually it's just you just see a dip in the price. They don't tell you that
Hmm.
they took out the cost.
Okay, so what you're saying, your overall strategy is cut out the middleman, become your own fund manager, if you will,
Sure.
and keep that 60% that was otherwise going into fees, keep it for yourself, whether you pull it out or reinvest it.
That's exactly right. And again, and I want to emphasize this more than anything. This is what you learn. What you learn is going to be more valuable than the actual money because that's going to be you're going to be able to take advantage of so many things because you've just paid attention. You've
Yeah.
just observed.
What does that mean? Or if I learn something, I'm gonna sell, or I'm gonna buy something similar? Like, what do I do with this learning?
Okay. Well, like I said, first of all is a crash. And let's say, for
Because I'm
instance,
thinking there's a crash coming up. I don't know. I'm not that
well, there
smart,
has
but it
been.
feels like there's a
We've
crash coming up.
we've had quite a dip, and so now is and so but the thing is because you know the price of what things were, and now they're lower, and nothing has really changed. They're still the same business. They still make the same money. Why did it go lower? I see. That's where you think. The name of my company is ThinkClink because I'm giving permission for everybody to think about it. You think about it. If you don't want to do it my way, that's fine. You've thought about it, and
Yeah,
so,
right.
but and
You're
Clink
critically
is the dividend.
thinking and analyzing, and then making choices based on
Yeah,
your circumstances and risk level
yeah,
because you're now educated.
yeah. Well, here's another good thing. Risk level. Um, I remember, and when you fill out an application for a form to open an IRA, they're going to ask you, what kind of investor are you? Are you aggressive? Are you value? Are you conservative? What does that mean? I mean, I think I know what it means, but what it does is it tells them what kind of products they're going to.
To market to you.
Yeah, exactly. So that's all that's for. But so what I'm saying is you just this conservative, aggressive thing, that's industry talk.
Yeah.
Okay. You just go in and you say, look, okay, I want a dividend yield that's above 3%. I want a company that I can understand. Not entirely, but I mean, I understand what BP does. They sell gas, the oil. AT&T, I got an idea what they. Pfizer is even a good company. I know they're not in
Oh,
every.
dude, it would have been an amazing company a year and a half ago. Dang,
Exactly. Yep.
I missed out on
Exactly.
that one.
Right. But and see, and here's the other thing about the companies that pay dividends. Now, what I show people is, for example, let's take Pfizer. Pfizer has been paying dividends for over 90 years. Okay. Here's the other key. They've increased that dividend every year
Mm.
since then. Not that you're going to get rich off the dividends, but you've found a company that's committed to the dividend. Okay. And so you can feel relatively at ease with that. They can cancel at any time. But usually these large companies, okay, first of all, for a beginning investor, these are companies that aren't going to go up and down really fast. They're just too large. Okay. So they don't go up. So if you want a lot of growth, it's not going to be an exciting deal. But you start seeing those dividends come in, and then every year they increase it a little bit. That just gives you a little warm feeling about, okay, I'm doing okay. Okay. And plus you're learning. You'll start to learn about the drugs they use or create. Okay. You're getting a little bit more into what you're buying. Okay. And it doesn't take a lot of research, a lot, you're not going to invest, 20, 30 hours a week in this. No. And what I tell people to do is just create a little narrative about the company. Okay, they sell drugs. Right now we got a pandemic going on. They're probably got some medicine that they can sell in large amounts now.
Well, I mean,
Well, it might be a
the
good
reason why
investment.
they've been so valuable for the last year and a half isn't necessarily that, but because there's competitors that do it. But it's because I don't know about outside of the U.S., but the U.S. government's been pushing them hard,
Yeah.
right?
Oh, yeah.
So not only do they have a solution to a problem, and it's very emotional, but we have even legislation or whatever that's
Right.
pushing
Yeah.
it hard.
Right.
I don't know if you heard this. I keep hearing that over 60% of Congress has invested in Pfizer, and it's like,
Yeah.
okay, maybe what we should do is just follow where Congress is investing, because they're going to
Yeah.
start making legislation to make those
Yeah.
companies more valuable. It makes me sick to even think about that,
Yeah.
but it's what happened, right?
Yeah. Yeah. Insider trading is not against the law in Congress,
Yeah.
even
Hey,
though they make the rules.
let me ask you a question, because I
Mhm.
still want to get to like where. That's one of my daughter's big
Where?
questions is like, okay, I got this money. Where do I go? What
Okay.
website or how do I sign up or whatever? I don't want to talk about that yet, though.
Okay.
I want to talk about, so clearly, you kind of poo-poo mutual funds for various reasons. And you're big on owning single stocks that have a dividend yield over 3%. And you're bigger on learning about all of this so that you basically become empowered and practicing, right? So buy
Mhm.
one and then buy another and then buy another, and by the time you get to 10, then you have some kind of education that you can start making better decisions and become a wiser investor moving forward. So what we haven't talked about, real estate's super sexy. Like everybody thinks they want to buy rentals or buy Airbnbs or
Mhm.
whatever. We haven't talked about what I think is kind of like a real estate mutual fund, the REIT,
REITs. Yeah.
REITs. So I'm wondering, aside from the idea, the strategy of single stock, dividend yield over 3%. Are there any other, what are these now, vehicles or tools? Probably vehicles. Are there any other investment vehicles that you're keen on, like you like, or you kind of like just kind of stick with this one thing, or where are you at on that?
Well, no, I'm pretty much because I really focus on beginners. Okay, and I really want them to understand. Now, you talked about a REIT. There are stocks that are REITs. One of my favorite ones, and
Is it
this
dividend yield?
yes, the dividend
All
yield.
right.
Gosh, I wish I knew exactly what it is, but I think it's around 4 or 5%,
Uh-huh.
and it's called Realty Income. Okay, and you can look it up. Go to Yahoo Finance. That's where I steer everybody.
Yeah.
Google Finance used to have the greatest website for beginners, and they changed it all up, and it's virtually worthless. But Yahoo Finance, you just go to Yahoo Finance and you can type in Realty Income, and you can see the dividend yield and all that. And here's the other thing about Realty Income that I like is they pay monthly dividends,
Oh, cool.
and not many companies do that. And they've increased. Oh gosh, they've increased their dividend over the last 30 years. I know it's probably 40, but at least over
Hmm.
30 years. So there's lots of good companies that do this, that pay the dividends. They're in my wheelhouse, and hopefully for a beginner. Now, because I just want people, I want them to give themselves some time
Yeah.
to get used to what a stock is, how it operates. Because once you hear about one company, let's say BP, you're going to hear about Shell, or you're going to hear about Chevron. Okay, there's going to be a cluster of knowledge you're going to gain just by virtue of you knowing one company. And so I'm just saying you can't help but learn. And that's why I don't like mutual funds. They just foster ignorance. And here's why
Well, that's one
Here,
reason why, right? Because the other reason is because they take 60% of my earnings.
well, yeah, that's true. And
I,
that was something I just learned. I mean,
yeah,
I knew that they charged, and I knew that some were ridiculous. And
yeah.
for small investors, they take 5% off the top. Okay, for small, if you have less than 25,000 and you buy a mutual fund, they take over 5%. So now you've got
Of
5%
the 25 grand or of my earnings.
of the price that you pay
Right. That
right
hurts
off.
right there.
Yeah, that's 5%. Remember we talked about inflation,
Yeah.
2 to 3%.
Wow.
You've got to have that thing grow 7% just to break even. Okay, and then they're going to charge you again for that year. So it's just an unfair way to invest. And
Yeah.
I get it that people don't want to be engaged like that, okay, because they think it's too. But that's what I'm trying to teach them.
Yeah.
One at a time. Get your dividends. Watch how it comes in. At least you'll know. Hey, oh yeah, it works. It works. I'm getting money. Okay, but just build from there, one at a time.
This is really interesting. This is not in line with what Dave Ramsey teaches.
It's not in line with what Dave Ramsey teaches.
No, he's pretty big on like get on the mutual fund.
Yeah. Oh yeah.
Have it in like A, B, and C, or the risk levels, and here's a percentage, and here's how you do it at different ages, and then let it sit, right?
Yeah.
And then you'll be fine at the end.
Yeah.
And that feels like very comfortable advice. Like it's like, okay, I can dump money every month into this thing and never. I mean, because I'm going to let other people do the heavy thinking, and they'll make adjustments as needed. So we're not becoming educated, right? We're fostering ignorance. But that whole 60% thing is like just grating at me right now.
Yeah, it's that shocked me, and that was an owner of a mutual fund company that was saying that, and I was like, holy cow!
All right, where are we going now? Let's talk about these actual tools. Like, what are some of your favorite tools to for either me mid-career? I think I'd like to be at the end of my career, but let's say I'm mid-career, or my kids who are barely just starting out, and honestly, they're living at home. Like they don't have rent expenses; they have very few expenses. So, if I were someone they listen to, how's that? I was going to say if I were their dad, I am their dad. If I were someone they listened to, and I said, dude, take like, take $100 or a couple $100 for spending money, and then take the rest and freaking invest it. Yeah. Holy cow. Like if I were to have done that with any money I earned before I was 21, man, I'd be on a nicer laptop right now.
Yeah. Well, and you said something that triggered, and now I'm this old age thing is getting
Let's go
tough.
to tools. Like where am I going?
Okay. Well,
trade.
Okay, to open an account,
okay,
you can go to there's Charles Schwab, there's E-Trade, there's TD Ameritrade. You could probably go to your local credit union or bank.
Really?
And open one up. Now, the only thing that I would caution about a bank is a bank, they survive on fees. And so they may have some
and I've helped them survive on fees.
Oh, have you been supporting the banking industry?
Yes. So bank or credit union is not your favorite.
I'm sorry?
The bank or the credit union is not your favorite.
Now, credit unions don't really charge. Okay. Credit unions are usually your least expensive bet. But it depends on what's easier for you. If you bank at some place and you go there often, okay, go ahead and do it there. But a lot of, especially kids nowadays, everything's online. So E-Trade, Ameritrade, TD Ameritrade, Charles Schwab, I mean, even Fidelity.
Are there some that are better or worse than others? Because you're throwing out stuff I'd expect to see in a list, but do I need to stay away from or gravitate towards some?
Well, I mean, like the Robinhoods, you can't open an IRA. See, that's the thing. I want young people to open an IRA. Now, I granted if they were to get a good gain, let's say from a crypto or something, and they want to take it out and spend it, okay, actually, this would be a good introduction to the IRS and how much their government likes them to make money.
Yeah.
But it's a good lesson that way. But I just want people to start slow, learn how the game goes, get your foundation set, and then go. Like I say, just because something now. If somebody says, "Okay, go be aggressive now," go. What does that mean? What do I do? Who? What? And then you just get into all kinds of trouble. And then who can you blame? You can't blame them, okay? Because they got paid, and you lost all your money. I mean, there's a lot of lawsuits out there too.
Sure.
But I don't want people to get into that situation.
Oh yeah, I don't want to be in that situation. All right,
Yeah.
let's stick on the tools here. So you don't really care where I go, TD Ameritrade, E-Trade, whatever,
No.
as long as I can set up an IRA, a traditional IRA, check the fees, right? Understand the fees.
Definitely.
And
most of
I'm
those
sure
that
there's
I just said,
100
they don't
blog
have
posts
fees.
out there. Say that?
I'm sorry. Now, those that I mentioned do not have fees.
Oh, they don't have fees.
Yeah.
So just set up a Roth, a traditional Roth, and start putting money in. Pick a company that has a yield and get up to 100 shares,
Okay.
and
That
then
has
go
a
do the next
yield,
one.
that a company that you understand basically what they do.
You understand that's a Warren Buffett thing. Like you got to understand kind of what's going on.
Yeah. So you can understand when there are dips and valleys, or wait, that's it. Tops and bottoms.
Yeah.
You can understand what's going on. Why? Because then you'll get to
Instead
the
of
point where,
panicking and
right,
selling, you could say, wait, nothing really changed here, or here's what happened, and I know it's going to be corrected, or this is happening in the entire industry, so it's just par for the course for this company.
right. Mm-hmm.
And then you decide whether, hold and buy on sale.
Right. Yep. You can do that. Yeah. But that's the thing. You're making the decision. Okay. Because after a while, I mean, I want them to start once they buy the first company. I mean, if they buy 100 shares, I want them to start looking for the second company. I don't want them to really start looking back at the other one because have you ever seen Monsters Inc.?
Oh yeah.
Do you remember the scene where Sully thinks that Boo is in the trash compactor?
Yeah.
And where he faints? That's your first day of investing. That's exactly your first day of investing, because it's almost like a law. First time you buy it, it's going to go down.
Yeah.
And you
That's
go, oh
funny.
my gosh, I made the biggest mistake of my life.
Yeah.
So
Or worse, it goes way up and you think you're a genius, and then you go do a whole bunch more without understanding what you're doing.
that is worse. You're right. That is worse.
Because you're making an uneducated and emotional decision.
Uh-huh.
And Rob, let's switch gears. You sell stuff. Like, you have a program, an educational program. Like, who are your clients and how does the relationship work?
Just beginners, mostly beginners. Now I do have some clients that I brought on that, well, I won't say I do it for them, I do it with them. Okay, but I have a series of videos that I go through, and it talks about opening the account, how to fund it, how to do it electronically and automatically, because I want it to be done where they don't have to think about it all the time, because they have to run down to the bank with a check
You're
they're
going to
just not going to
forget.
do
You're
it.
going to spend your money.
Yeah.
Like, it's not going to happen. If it's not automated, it's not going to happen for most people.
Right. And just doing like an allotment. Most companies will allow you to send money from your paycheck to institutions.
Yeah.
I know the military can do that. Yeah. And so I have a video too also on how to look for a company, how to look at a company. And I also have one for reading statements. Okay. Unfortunately, they're not on there yet because I don't know how to edit videos that well.
Yeah.
And so it's a fit and start kind of thing, but it's going to show them step by step. I mean, it's
Yeah.
going to be a hand holding because I, and
So
then,
your
and it,
program isn't one-on-one on the phone. It's just a series of videos, right? So like
well, video,
self-paced
yes,
on
but
demand.
if you do the program, yeah, you'll get 2 calls from me. You get
Okay.
to call me twice. And I've had several people do that because they get stuck. Like the last one, he was in a bank and they said, well, they want to charge me $200. And I'm going, well, you need to walk out. But he misunderstood. It was $200 if he wasn't there for 2 years,
Yeah.
So, but I'm glad he called.
Sure.
So he asked the question,
Yeah.
and I was able to ask more questions from the bank. So it's just because they don't know, and they're usually in a position. Okay, remember I was a broker, and I worked with hundreds of brokers. Okay, there's only one broker I would ever trust with my money. One. And it wasn't me. I mean, there's another individual that I would trust, and that was shocking to me.
What
Now,
was it about that person? Was it that they had high integrity, like you felt
yes,
like they were super honest, or they were a good educator, or they were highly successful? Like what was about that
well,
one?
because of the first two, okay, he was very ethical. Okay, was not going to sell you anything you didn't really understand, and and the reason I liked him too is because he could understand a financial analyst. Financial analysts don't speak English, and for the life of me, I still have yet to understand one.
Yeah.
But he was able to do that, but also make it simple. He was able to make it simple for them, so they were comfortable. They weren't just trusting him with their money, because he didn't want that. He goes, look, yeah, I want you to trust me, but you need to understand this. And so he was never putting in people in complicated products. He made sure that they understood everything that they were doing, what to expect, but also, yeah, you could lose everything. This is the stock market. Okay, but the probability of that happening is slim to none.
Yeah, pretty low.
Yeah.
Well,
So
and I remember a quote on that note. Warren Buffett was challenged one day from someone. He was at some conference thing, and some
mhm,
kid got on the mic, and they were like, "Hey, you just lost $1 billion from whatever," and he's like, "I didn't lose anything. You only lose when you sell, right?
mhm,
So even if the stock market crashes and goes way down, as long as you don't like cash out for pennies on the dollar, then you didn't lose anything."
right. And that's good because it takes the emotion out of it.
Yeah.
Okay. Because if you think, oh, it's only on paper, is this company still strong? Is it still one of the best in the business? Yes. Let it ride.
Yeah. How let's wrap this up. How do people find your program, or like how do they get in touch with you?
Well, it's at thinklink.com. But I do have about 2 seminars a month, okay, through my meetup group, and that's at meetup.com. And I've got the link. You said there was a chat area. Is there?
Yeah, and I'll put this on YouTube in the description and on
Okay.
Facebook. So Meetup, if I go to Meetup, what do I search for? Rob Saunders or
You
Think Clink?
look for beginning investors.
Beginning investors, and we should find you.
Yes, I should be one of
And
the.
so twice a month, what are we expecting? Like, are you going into like, here's some companies that I'm looking at and evaluating? Are you showing how to do that, or what are you doing?
Well, yeah, we'll go through companies, okay, and why I do or don't like them.
Okay,
Because
that's cool.
if and also you'll understand too that most of your technology companies do not pay dividends
Right.
because they have to have all that profit for research and development because it
And
changes
growth
every
and all
day.
that.
hmm Yeah, and now your company that you work for is public, correct? Pluralsight?
Uh, well, I don't work for a company, but you're probably thinking of Pluralsight, who I do
Yes.
courses for.
Oh, uh-huh.
and they were public. And then I think almost like last summer, I think they were whatever the word is for going out of public. Private equity firm acquired them,
Oh, right.
so they're
Okay.
not public anymore, but they used to be.
Right. Okay. Okay. Well, but that's how you get a hold of me. The best way is through the meetup group
Okay,
because you can email
meetup,
me.
and then look for beginning investors.
Yep.
Okay, I'm gonna go do that because I would love to watch over your shoulder as you evaluate companies and kind of out loud think about, here's what I like, here's what I don't like. I actually would invest in this enthusiastically, or like, yeah,
Mhm.
this looks pretty good. There's probably some better ones out there.
Yeah. Well, there's one thing about what I do is I cannot recommend
Yeah.
stock.
Yeah, you
I,
got a lot of handcuffs on you in the
yeah.
financial
Exactly. Yeah.
space.
Yeah. But what I do is I teach,
Yeah,
and you make your own decisions. And the
I
thing
I
is,
understand that.
yeah. And the one thing too is everybody, you've already done harder things than investing. If you've learned how to drive, if you've had a new job, if you raised a family, if you had a baby, if you're a
Yeah,
woman, you've already done harder
for
things than
sure.
investing. So
The thing about investing is it can be so emotional, and there's so many aspects of that. It's like, hey, where did my money go? Like, oh my gosh, I lost this much money, right? Or I gained this much money, or FOMO, man, like fear of missing out. That is all over the place right now with everyone like, oh yeah, I was just reading about this kid who got lucky and invested in Tesla super early on and made a few $1 million, and then flipped that into real estate investments. And it's like, why wasn't I doing that? Like, I
yeah,
was I was around the same time, but I mean, there's a lot of fear of missing out going
yeah.
on.
Well, and the comment I get most often from especially people our age is, I wish somebody would have told me this 15 years ago
Yeah.
because they really didn't even know what a dividend was.
Yeah.
And and if you ask, you can ask 10 people, 9 out of 10 probably aren't going to be able to give you a coherent answer.
Yeah. Well, this changes the way I'm thinking about my own money and my investments. Because really, what I want to do is just take a couple $100 or however much a month and just throw it into high risk mutual
Mhm.
fund, and then do my thing. I'm involved in multiple businesses. I got a lot going on. I got a growing family. I'm trying to enjoy life. I don't want to like sit behind a computer and like study this all the time.
Right. Yeah.
But at the same time, the idea of knowing that there are other really wise and good things to do as far as investment goes, that's not a high risk mutual fund that now I know has really high cost behind it.
Mhm.
I'm going to think about this. I'm going to jump on your meetups and look over your shoulder as you evaluate companies and understand that,
I
and
would
go for
appreciate
my
that.
100. I'm going to go buy 100 shares of something. I don't know what, but I'll get
Yeah.
educated and I'll buy 100
Okay.
shares of something.
You got my vote.
All right.
Thank you.
Hey, thanks for your time. Stay on. I'm going to end this here in a minute, but stay on. I'll chat with you in a minute.
Okay.
To everybody else, thanks for coming. I will put some links in the description on YouTube and Facebook. And good luck with your investing. Hopefully, you can be wise. I think for me, one of the most important things I'm getting out of this is that there are actually multiple good options. And I'm going to tweet about this in a little bit. But one thing that I'm kind of putting a couple things together, because I like to take everything I learn from wherever
Mhm.
and tie it into career and job search, right? Because that's my main audience is job seekers,
Right.
and with plural site learners, right? People who are learning. And one of the key parts of a formula in investments is time, right? Because we talk
Mhm.
about compound interest, and compound interest compounds over time, right? And so time is a huge aspect of the success of your investments. Time's also a huge aspect in our careers and our learning. And too often, I think we're like, I want to be here right now. I want to know this right now. I want. And we're a very impatient people. And so I'm just going to encourage you, or maybe just make it okay, give you permission to allow time to be a part of your path and formula for success. So with that, I'm going to end. Thanks, everybody. We'll talk to you later, and hopefully we'll do this more frequently. Rob, stay on.